All right. Hello, everyone. Um, we are really happy that you joined us. Hello, dear guests. So today we are here to discuss the USA core durable goods orders, and me and Max are here to cover this data release for you. So as you can see on my screen, core durable goods orders are expected to come out at minus 0.3%, while the prior figures stood at 1.7%. So let's talk a little bit more about the history of the indicator. And for that purpose, I would love to remind you that the US durable goods rose much more than expected in January, while core orders also jumped sharply, easing concerns over the health of the economy. The official data showed last month. In a report, the U.S. Commerce Department said that total durable goods orders, which include transportation items, rose by a seasonally adjusted 4.9% last month, blowing past forecasts for a rise of 2.5%. Orders for durable goods in December fell 4.6%, whose figure was revised from a previously reported decline of 5%. Durable goods are typically bulky or heavy products designed to last at least 3 years. So they showed as I said already, a surprising jump. While the core durable goods, excluding transportation, increased by a seasonally adjusted 1.7% in January, easily surpassing expectations for a gain of 0.2%. Core durable goods orders also slumped the month before that, in December, to 0.7%. What else? Orders for core capital goods jumped 3.9 last month, far better than forecast for a gain of 1%, and following a drop of 3.7 a month earlier. Shipments of core capital goods, a category used to calculate the quarterly economic growth, dipped 0.4% in January compared to the forecast of a gain of 0.8%, while the jobless claims were expected to rise from the lows of 262,000 to 270,000 this week. Let's move on. Where is another one? Yeah, here they go. We have the experts giving their estimates on the matter, and according to their views, we have the Bloomberg Server summary, as always, where the median estimate stands at minus 0.3, average estimate stands at minus 0.23, highest estimate is 0.5, and the lowest estimate is minus 0.3% according to the experts, which hit the number of 53 this time. Let's see. No, not much saying here. Let's move on to the Dukascopy community member sentiment on the dollar-Japanese yen currency pair. And you can see on my screen that Dukascopy traders are, well, a little bit more bullish on the matter, 55% bullish votes versus 45% bearish ones. And of course, you can see a couple of comments on my screen. For example, William B says that the durable goods orders improved in January after a negative figure in December, and a good news for the U.S. economy because such orders regard the investment, but the slowdown in the pound's growth rate could hit durable goods orders. Well, not the pound, of course, GDP, what I'm talking about. What else? Yeah, the next trader is a bull, and he says that last month we saw a rebound, of course, which indicates that purchasing managers remain optimistic and expect consumer demand to pick up in the coming months. So he is bullish on the pair. And right now, I would really love to give the floor to Max, who's going to cover the technicals for you, because from my side, that would be it. So please, Max, go ahead.
Thank you very much, Kate. Hello, guys. I hope you all have a great Thursday so far. Speaking about the technical part for this particular data release, we have the negative surprise trading strategy today because the data is expected to come out quite weak for February. Of course, it will follow very strong numbers indeed for the first month of this year, but nonetheless, the expectations are quite dampened today. And Even though the average expectation suggests that orders declined by 3% on a monthly basis, there are some expectations from some separate financial institutions. The Kate has already showed you some of them, but I will one more time mention, let's say, the Bank of America's Merrill Lynch expectation for a minus 5.2% change, while Deutsche Bank Securities, they expect a drop of 4%, and JP Morgan Chase foresees a slump of 3.9% on a monthly basis. So the expectations from really big financial institutions are quite pessimistic for today, and the same also goes for the core durable goods orders as well. Okay. Now moving on to the trading strategy and the dollar yen, of course, currency pair, you can see that the sentiment actually for this currency pair is bullish. At the same time, I would like you to pay attention to the pending orders, which are a kind of a future predictor of the movement of the pair, can be considered as at least. And they are set to sell the dollar versus the Japanese yen in the majority of all the cases, and especially in 100 pip range from the current spot price. They are set to sell the greenback in almost 75% of all the cases at the moment. Moving on to the current trading situation, you can see that right now the pair is hovering at the level of 112.59. And of course, as usual, to project the possible reaction of the market to the data itself, let's have a look at the previous reactions for the same data release for the dollar-yen currency pair. Here in the table, the reactions are measured in pips. The reaction of the first minute of trading after the data is published. And you can see that the calculated average of the last 5 months was 12 pips, quite a small actually market reaction. At the same time, in the last 2 months, they were quite above average at 15 and 22 pips respectively. And therefore, we of course are going conservative, so we are projecting some conservative estimates for the reaction. And in case we have a really disappointing data from the US this time, in case the orders indeed decline or decline even more than it is expected, we can see the dollar plummeting below 112.50 level. At the same time, there can also be a positive surprise, because even in case the data is released better than expected and it still declines, let's say by 1 or 2%, it also can be considered as a more positive signal, because it is better than the estimate had suggested. In such a case, we can see the dollar appreciating against the yen, possibly into the area above the 200 period simple moving average line, this time the 200 minute simple moving average line, at 112.71. So I just have a couple of seconds to go. Let me mention the technical indicators, which are actually also set to go short on the US dollar in the vast majority of all the cases on the short-term time frame. Okay, I think we just have a couple of seconds to go, and we actually can see some downward initial market reaction from the dollar. The first initial take profit level is still not reached, but it's very close to that. Let's see what the numbers actually are. And here we go. The durable goods orders, which are the headline ones, declined by 2.8%, which is a bit better than it was expected of -3%, while core orders declined much more than they had been expected to drop by 1% against the expectation for a -0.3% decrease. But of course, it's kind of a normal situation when monthly data is usually volatile, and after such a rapid increase in January, it would be logical to assume a kind of a correction to the downside in February. At the same time, you can see that in case in our case, the January increase outperforms a decline from February, which is a really good signal that on general the orders are on the recovery phase at the moment. Okay, I think that from my side that will be all for today for this particular data release. Thank you very much, guys, for your attention. I wish you all a very great day indeed, and of course a happy Easter. See you all just very soon, and I give the floor back to you, Kate.
Thank you very much, Matt. Thank you, guys. You can see the numbers in the chat. And also you can still see the reaction, which was not that big anyway. But yeah, that will be it from our side for today. See you tomorrow with another data release, another webinar. And we are always happy to do that for you. And we also would like to ask Carol to proceed. Maybe you need some 10 minutes to finish with your webinar. And because there is no one after you. So if you wish, you can finish with your webinar right now. Thanks once again.